The interest rates on fintech apps like RiseVest, PiggyVest, and MoneyBack have been remarkably high in recent times. Some of them are doing as high as 28% per annum. And these apps are not alone. Even Nigerian instruments like bonds, commercial papers, mutual funds, treasury bills have returned a remarkably high interest rate over the last 1 year. Question that you may have, or question you should have asked is, why is interest rate so high in Nigeria? Or will these interest rates on these fintech apps and this Nigerian instrument continue to be like this forever? Or there's coming a time when the interest rates would reduce? Hi, my name is Okolocha. I'm a personal finance evangelist, and on this YouTube channel, I talk about money, investing, business, economics, and anything that pertains to making the right money decision so that with the income you earn today, you can build transgenerational wealth. If you just found this channel, please hit the subscribe button, and I promise you for any minute you spend on this channel, you're not going to regret it. So, what is MPR? MPR stands for Monetary Policy Rates. This is the official interest rate set by the Central Bank of Nigeria. And this is not limited to only Nigeria. In other economies, even in the United States, they have a committee that is responsible for setting the interest rates for their Federal Reserve Bank. In our case, it's the Central Bank of Nigeria. The monetary policy rate is one of those tools that the federal government uses to manage the economy. So, why is this important to us? First of all, let's look at what the monetary policy rate has been like in the last 10 years. This is 2020. It was 13.5% in 2020. 2021, it dropped to 11.5%. In 2022, it was also 11.5%. That means for 1 year, the monetary policy rate did not change. I can't remember what exactly happened this period, but I'm sure if you eager to learn more, you can research to find out what exactly happened that made the MPR to remain the same throughout a 1 year period. In 2023, it increased to 18.08%, and then 2024, it increased again to 24.75%, and now in 2025, it sat at 27.50%. What's interesting to note is that this has not changed this year. The last meeting that the Monetary Policy Committee had, they decided not to increase the interest rate. But before January this year, throughout 2024, there was a consecutive increase in interest rates. The question now is, why was the Monetary Policy Committee increasing the interest rates anytime they sat? One of the reasons why they were doing that was to manage what is called CPI. If you watch day 3 of the Economics 101 series, I talked about CPI. CPI stands for inflation rate, right? So, inflation throughout last year was on an onward increase. Every month that went by, inflation rates increased. And so the MPC thought that, let's see how we can reduce cash flow in the economy. And how can they do that? Is by increasing interest rates. When CBN increases interest rates, it also affects the interest rates from commercial banks, from mortgage institutions, and so on. Business owners will no longer be excited to take as much loans as they used to because it will now cost them much more to return back those loans. Aside from business owners, even salaried workers, they're not going to be excited anymore to take loans because it's going to cost them much more to return back those loans. So people that usually take loans maybe to buy a house or to buy a car, they are not going to be considerate on what to do. So when this interest rate is increased also, it is a way for taking money out of the economy. Instruments like bonds, treasury bills, and so on would also increase in interest rates. So more people are going to invest in these instruments, thereby sucking money away from the economy. And according to basic economics, when there is limited flow of cash in the economy, it's going to reduce the demand for goods and services. And when the demand for goods and services reduces, price stops going up drastically. However, this only works in a sane economy like United States or maybe United Kingdom. When interest rates is increased, it directly has an impact on inflation rates. But in our economy, where the kind of economics we practice here is not literal, sometimes increasing interest rates really does not affect inflation rates. And I explained it in another video where I talked about devaluation. The reason why our inflation rate is unique is because we import most of the products that we consume in the country. So even whilst interest rate is increasing, in order to manage the inflation rate doesn't actually drop. But recently, CPI was reduced, and that was after the rebasement. We talked about this in day 2 of our Economics 101 series. After the rebasement, inflation rate dropped to 24.48%, and from 24.48%, it's in February dropped to 23.18%. So you can see now that inflation is dropping, and that is the reason why the Monetary Policy Committee did not increase interest rates last month that they sat. And there's also a forecast that next time they sit, there's going to be a reduction in this interest rate, or they might not increase it, just leave it the way it is. This is why the interest rates on some mutual funds have stopped going up like they were going up on a monthly basis last year. If you're an MPR community, you must have heard me say this is the year of the Naira. Number one reason why I said that is that interest rate is high and inflation rate is dropping. Anytime interest rate is higher than inflation rate, it then means that it is profitable to invest in the Nigerian economy. This is the first time in a long time. In fact, since I started paying attention to Nigerian economy, I've never seen when interest rate is higher than inflation rate. So this is a time to be alive in Nigeria. This is a time to invest as much as you can in Naira instruments like bonds, mutual funds. Take advantage of these fintech apps and put your Naira in there instead of leaving your Naira in the bank. Most commercial banks return less than 8% per annum on your savings. So leaving your money in your commercial bank, you are losing, because the interest rate on commercial banks is less than the current inflation rate. I'm sure I've answered those questions in the beginning. Number one was, why is the interest rate so high? I told you already, it was done to manage inflation rates. And that question is, will this interest rate continue going up, or will it continue to be like this? No, it's not going to be like this forever. Interest rate at some point will have to start dropping so that it can improve productivity in the economy. When interest rate drops, companies, industries can take more loan from the banks and help to boost their business. When their business improves, they're going to employ more skilled and unskilled labor, and that will make everybody happier. Recently, people complain of unemployment in Nigeria. One of the reasons why unemployment is high is because of this high interest rate. So for unemployment to reduce, this interest rate has to go down so that the employers can take loan and spend money on recruiting more staff and buying more machineries to increase productivity. When productivity increases in the economy, more people earn money, more people spend money, and then everybody's happy. The person that's selling tomatoes in the market or selling electronics in another international market, the only reason why he can be able to sell is when salaried earners, take money that they earn from their 8 to 5 to go to the market. So if salaried earners are not making enough money, then there'll be no spending. In some way, it's good that interest rate is high, so take advantage of it. But it's not good in the long run for the economy. So I expect this interest rate to drop anytime soon. Thanks for watching, and don't forget to hit the subscribe button. See you in the next one.